Okay, good afternoon. Welcome to another edition of the World Bank online seminar. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank, based in Tokyo. Today, we are extremely pleased to be able to return to the at least a hybrid mode, having a face-to-face, in-person participant in a conference room. As we are having the team in charge of the commodity market analysis, John Buffett and Peter Nego visiting Tokyo this week, we do not want to miss this opportunity to organize the seminar to introduce the very latest edition of the Commodity Market Outlook, which actually was released on October 26th, last week in Washington time. This is going to be the seminar asking John Buffett, who is the senior agricultural economist of the Prospect Group, to introduce the main point of the commodity market outlook. And then we have a pleasure of having Mr. Tatsu Koizumi from the Ministry of Agriculture today as a commentator to share his comment right after John's presentation. And then, as usual, we open up the floor for your question. For those of you who are in this room, this is going to be your opportunity to raise questions directly to a speaker. If you are participating this seminar virtually, please send your question to us by the online form posted on the announcement page of this the seminar, or you can simply post your question on the chat section of the YouTube screen. So I'll read your question during the Q&A time. With that, I'd like to ask John to come in to start your very first in-person event presentation right after we enter this session. John, please.
Thank you, Koichi, very much. Thanks a lot, Koichi, for arranging this, and I would like to thank the World Bank office here in Tokyo for making this event taking place. I would also like to thank a number of colleagues, of course, most importantly, my colleague Pete Nagel, who is a co-author of this report, but I would also like to thank a number of colleagues back in Washington who very tirelessly helped us to put this report together. Let me begin by highlighting a few key messages that come out of the report. And the first message is that the world economy is facing a sharp growth slowdown that is certainly affecting commodity markets. But I would also like to mention here that because the currencies in many countries have depreciated quite a bit against the dollar, the declines that we have experienced recently in some commodity markets, they have not translated in declines in domestic prices. In fact, on some occasions, domestic prices have increased. In terms of forecasts, we expect energy prices, the energy price index, to fall a little in 2023, around 11%, probably by a similar amount in 2014. Looking at the prices of oil, the Brent crude oil prices, we expect them to average $92 a barrel in 2023, and probably ease a bit more next year into the year after in 2024 to $80 per barrel. Now, when it comes to non-energy commodities, especially agricultural prices and metal prices, we expect them to decline by about 5% and 15% respectively in 2023. And we expect those groups of commodities, the prices rather of those two groups of commodities, to stabilize in 2024. Now, having said that, it's very important to highlight the fact that those forecasts are subjected to a large number of risks. I outlined just a few here, but there are much more than we'll elaborate later on in the presentation. From the energy side, we expect an array of supply concerns as worries about the availability of energy during the upcoming season, upcoming winter, could intensify in Europe, although things look a little better now than they used to a month or two ago. The other risk rather is that higher than expected energy prices could pass through to non-energy commodities. That especially could affect food prices because most food commodity markets, the production of food commodities is an energy-intensive process. So whenever energy prices go up, that has a huge impact on the production cost of food commodities. Lastly, or rather thirdly, the important risk is what's going to happen to the global economy. If the global economy slows down more than anticipated, that could have an important income on the demand side of commodities. Now, let me focus now a bit deeper on commodity prices. And we have our three indices here: energy, agriculture, and metals. We do see the kind of decline that took place in energy prices earlier in the pandemic. The effect was much less severe on metals and agriculture. And then we see here the huge rebound that took place after the pandemic, in part due to the higher than expected growth in the global economy. But what we also see is that during the past 2 quarters, commodity prices have sort of diverged. Energy prices have stayed high, although they have retreated a little during the past 2 months, but agricultural and metal prices have declined quite a bit. Now, this is the picture at a global level. Those prices are at an international level. When we look at domestic prices, however, the picture, as I said earlier, is quite different. In this chart, we are showing the price change between the price change on a year-to-date basis between January and September. To the right, we see how much the price of oil and how much the price of wheat changed during this period. And as you can see, the changes are very small. For example, oil declined by 6% and wheat increased by 7% during this period of time. However, when we look at the same price changes in domestic currency terms, the price changes are much larger. And we see, for example, in Turkey, that the wheat price increased almost 45%. We see even advanced economies like Japan, the UK, the European Union, that prices of commodities have increased much more than what they did in dollar terms. And that, of course, reflects the fact that the currencies in these countries have depreciated quite a bit against the dollar. Let me now move to the analyzing commodity, looking in more detail in commodity markets, specific commodity markets. I will start with energy. And here we see the price of Brent crude oil, which had been fluctuating around an average of 60 to 70% throughout the past 3 years. But following the pandemic and the huge reduction, then we see the huge increase in price, which exceeded rather $100 late last year and early this year. But we do see a reduction in the price of crude oil during the past few months. Now, there are a number of reasons why we saw those price increase in crude oil. Let me focus on what happened in inventories in the United States, for example, which, by the way, is one of the 3 major producers of crude oil around the world, along with Russia Federation and Saudi Arabia. What we see here is that crude oil, when prices of crude oil started decreasing, the United States engaged in releasing the quite important large quantities of crude oil into the U.S. market, but by extension, it of course affects the global market. And what we see is that the SPR levels currently have returned to levels that we have not seen since 1982. So we have seen a huge release of SPR reserves by the United States. Now, what happens also in the oil market is that on the supply side, apart from the release that we have seen from stocks, we have seen a shortfall in production by OPEC countries, by OPEC plus countries. OPEC decided to cut supplies further recently during their meeting of October 5th. The announcement was that the supplies by OPEC, the quotas would be cut, the supplies would be cut by 2 million barrels per day. Just to put this number into perspective, the world consumes or produces and consumes at the same time 100 million barrels per day. So the 2 million suggested cut by the OPEC corresponds to about 2% of the global market. However, a number of countries by OPEC plus countries operate other quotas. So in fact, although OPEC suggested a 2% or a 2 million barrels per day reduction, in fact, this reduction is going to be in the neighborhood of 1 million barrels per day. Now, we also had seen developments, supply developments in the United States. The United States had a huge increase in oil production through shale oil, and that has taken place for the past decade or so. And in earlier times, in earlier years, whenever prices of oil increased, that would trigger a supply response by the United States, the US shale industry in the United States. Now, this did not happen as was anticipated, or it took place, but not as much as was anticipated in the current phase of the oil price increase. So the response by the US was much weaker than expected, and two of the reasons that it was weaker was that the companies that produce shale oil in the United States, initially they were small companies, but now a lot of them have been purchased by what we call the major companies. And the independent companies earlier were focusing on production, so whenever prices of oil went up, they would increase production. But currently, the major companies are more interested in delivering profits to shareholders rather than increase production. And that's why what we see here is that the rig count, for example, in the United States has not responded as it was expected. And also another measure of supply response, which is the drilled but uncompleted wells, also has gone down quite a bit. So in a sense, those two metrics show us a summary. It's a summary statistic of the capacity of the United States to produce oil, and we see that the capacity now is much weaker than it used to be in the past. So those are the two main reasons, so to speak, as to why we see high price of oil. Now, turning to the other energy markets, natural gas prices, as we all know, have increased a lot, especially in the European Union. Depending on the time you look at it, prices in the European Union, natural gas prices have increased probably by a factor of 5 or even a factor of 10 in some months. Prices elsewhere increased probably by similar amounts. For example, cash prices for spot prices for LNG in East Asia increased probably as much as the European natural gas prices. We also experienced the United States natural gas prices increased quite a bit, but not as much as the European gas prices. And here it's very important to realize that to see that the scale of the two prices is different. So the European gas market faced some challenges earlier, during this year. Initially, there were fears that there would be supply disruptions or probably some what they call rationing in natural gas in Europe. But most of the European countries were very aggressive in refilling the inventories of natural gas. And we can see, for example, by what is depicted in the dark blue line there, that in 2022, for example, the European natural gas inventories have been higher than, of course, what had been in 2021, and that what they have been on average during the 5-year period between 2017 and 2021. The message here is that Europe is probably in a better position now than what we anticipated 1 or 2 months ago, as this chart depicts, shows. So if there's not a harsh winter in Europe, probably they can get by with European countries. Most European countries can do get by, given the high level of inventories that have been built during the up to now, but they may have problems certainly next year and in the longer term, as it's quite uncertain and unlikely that supplies from Russia will return to earlier levels. Now, lastly, in terms of energy markets, I would like to take a quick look at coal prices, and we see that to the chart of the left, coal prices which had averaged around $100 per ton to the 3 or 4 years prior, in fact, even the long term prior to the spike. Now we see that coal prices on some occasions are traded, or coal rather is traded at $400 or even close to $500 per ton, which is 4 to 5 times as much. Now, there are a number of reasons, of course, why coal prices increased. A lot of countries, because they could not produce electricity from natural gas, they turned into coal, so the demand for coal increased quite a bit. That's the short-term reason. There were also issues in other types of energy, especially in hydroelectricity. There were weather issues in South America, in the United States, including and also in China. They do not produce as much electricity rather from hydroelectric stations as in the past, so they also turned into coal. And the third reason, which also is of a more longer term nature, is that the coal capacity or the coal plants around the world, because of the climate concerns, they have gone down. So there are issues as well on the supply side, and that's why we see coal prices going up. Let me turn now to this change to the other commodity markets, the second group of commodity markets, which is metals. And we see here in metals that both the base metal price index as well as the iron ore, which is the most important ore in the chart to the right, you see that we have a huge decline in prices. And one of the main reasons why we have decline in prices in the price of metals is because the global manufacturing activity has weakened quite a lot recently, of course, because of the concerns about the global economy. But when it comes to metal, it's very important to put this picture into perspective. Sorry, I should keep that. In the case of metals, China is a very important producer of, is a very important consumer of metals. China consumes about 50% or more than that, 55 to 60% of global metal consumption. It accounts for 55% of global metal consumption. So China really affects the global metal markets. So now let me briefly talk a bit, give a couple of charts on the precious metals markets before I turn to agriculture. And precious metals is a very interesting commodity in that it is affected both by the interest rate, by the macroeconomic conditions, especially interest rates, because when interest rates go up, as it is the case now, investors turn to they do not buy gold, but instead they buy currencies. While when interest rates go low, I mean, investors get into the precious metals markets. That's probably the case of gold, and you can see that to the chart of the right, how interest rates which, by the way, are depicted in inverted scale, and the gold price move together, both in the short term and the long term. But at the same time, some metals, for example, silver and platinum, are also used for industrial purposes. And that's why we've seen the prices of those two commodities, those two precious metals, to go down recently. So now let me turn into a much more important market in terms of security, food security, and this is, we see here the agricultural prices. We separate them into agricultural price into three indices: the food price index, the beverage price index, and the raw material price index. Raw materials consists of commodities such as natural rubber, timber, cotton, and we see that this group of commodities, in the sense, mimics the behavior of metal prices, as I showed you earlier, and in fact, we do see clearly the decline in those two commodities, in this group of commodities that have taken place during the past 2 quarters, which reflects concern about the global activity. The beverage commodities, which are precisely what the term says, the term indicates, it's coffee, tea, and cocoa, etc. This index increased quite a bit over the past 2 years or a year and a half, and that reflects one single event, is that Brazil had a very bad crop last year in coffee, so there were huge declines in global coffee production. That kind of brought up, pushed the index, the beverage index up. Now, when we look at the food commodities, the picture is quite different there. We experienced a huge run-up in food commodity prices throughout the past 1.5 years or 2 years, and there are a number of reasons for this. First, we had experienced bad crops, especially in South America, which affected quite a bit the supplies of soybeans. We also had problems. There were also some problems in North America in maize, and also some problems in production of wheat. So that's the first reason. But the second reason is, of course, that the energy prices went up, and some of those commodities in the food group, especially grains, rice, maize, and wheat, are very energy intensive. So when energy prices go up, fertilizer prices go up, and that affects the cost of production of those two commodities. And the most important factor, especially for the past 2 quarters, 3 quarters or so, has been the war in Ukraine, which disrupted supplies of several grains, but most importantly, wheat. Wheat exports came to a halt from the Ukraine, and that's why we saw the price increase in the food, the increase in the food price index. We do see a decline that took place during the past quarter, and that reflects better news from some crops from South America, as well as the fact that Russia, Ukraine, and Turkey facilitated an agreement by which the resumption of grains export of grains took place from the Black Sea region. This agreement came into effect in mid-July, and it worked quite well in the sense that about half of the Ukrainian supplies of wheat found their way to the global market. The Ukrainian inventories were at the levels of, I believe, 20 million tons during the invasion of Russia's invasion, but because of the UN-backed agreement, about half of that, around 10 million tons, found their way to the global market. Now, of course, the picture changed quite drastically the last few days. Russia decided to suspend the UN-backed deal. We do not know a lot of details if the suspension applies immediately, because the deal was supposed to be in effect until November. And we also do not know if the suspension means that the deal is completely off the table or another kind of agreement is going to take place. So there's quite a bit of uncertainty in the global grain markets, especially in the wheat market. It's a bit too early to have a good assessment. We perhaps should know more in the coming weeks. In terms of prices, there was one element that I would like to draw your attention here. We're depicting here the prices of four main commodities: wheat, maize, rice, and soybeans. As you can see clearly that all those commodities, the three of those commodities, wheat, rice, and wheat, maize, and soybeans, have increased quite a bit, especially wheat because of Ukraine and soybeans because of the shortfall in South America. The interesting pattern is in rice, which compared to the other commodities has been quite stable, or at least low. It did not spike compared to, let's say, wheat or soybeans. And the reason is that the rice market, or rather, the rice supplies, there was favorable weather in most of East Asian countries, so rice supplies have been quite strong compared to the supplies of other commodities. Now, it's important because, as I will show you later, that has an important effect in the region, because the food price inflation in this region, the East Asia region, has been less than the food price inflation in other regions of the world. That's in part reflects the fact that rice prices have not increased as much as other prices. Now, let me summarize the outlook for the upcoming season. That is the season, the crop season that started in August of this year. This shows the year-to-year change of aggregate grains, the chart to the left, and aggregate oil seeds, the supply of oil seeds, the growth, the chart to the right. And we see a shortfall in grains for next season in about 50 million tons. That mainly reflects a shortfall in maize, and to a lesser extent rice. Rice is also going to be a bit tighter this season than what has been on average in the past decade or so. To the right, we see a completely different picture. Edible oil supply growth is going to be quite strong this year, much stronger than the average. By the way, the red lines indicate the 30-year average growth of both grain supplies and edible oil supplies. And we can see that edible oil supplies are going to be much higher than the long-term average. Now, in terms of the overall situation in the food commodity markets, one sort of metric that we typically use, the industry experts use, is the so-called stock-to-use ratio, which in a sense it's a measure of inventories of food supplies, food commodities compared to consumption. This ratio is a kind of a very important and well kind of watched barometer as to how the food supplies or to commodity supplies are doing. And we can see clearly that we have a kind of tightness in the market in the global food markets in the past 4 to 5 seasons, where this ratio of stock-to-use ratio reached a high of 31% back in 2017, and since then has been gradually declining. And for the current season, it's expected to be 27%, which of course reflects the tight supplies that we have experienced the past few years. But when we compare the 20% now with the recent history, we see that, for example, in 2006 and 2007, that ratio was 17%. So it was back then almost half of what it was at its peak. It's in either 2000 or 2017. And that is another reason as to why, while we did see increases in food prices, we did not see the sharp spikes that we experienced back in 2006, 2007. Of course, that situation can be reversed quite quickly if there's a bad crop or one or two regions that can be reversed, as it was the case. You can see here clearly back in between 2000 and 2004, 2003, when there were a few bad crops around the world, how that ratio declined quite a bit. Now, lastly, in terms of what affects global markets, global food markets, we have seen some trade restrictions, in fact, a lot of trade restrictions taking place recently, both in during COVID-19, as well as during the Ukraine crisis. But when we compare those trade restrictions with the restrictions that took place back in the food price spikes of 2008 and 2009, although the number of those trade restrictions is the same, it was back then, the effect of those trade restrictions is probably less severe now, and the reason is now it's applied to more commodities, but to less important commodities. Back in the 2007 and 2008, the trade restrictions were applied mostly to rice and to a great extent to wheat, and that's why you had a much sharper effect back then compared to now. But again, from our perspective, trade restrictions is a very important concern. It's a concern that we caution policymakers to not engage in those restrictions such as export bans, because the moment one country introduces an export ban, then you have kind of the same reaction by other countries that can induce quite a bit of volatility around the global markets. Lastly, let me highlight a point that I made earlier on the food price inflation. To the left, we see the year-to-date increase in the world food price, which is the index that we monitor and the index that I showed you earlier in the presentation. And in the blue bars in the chart to the left, we see the food price inflation in year-to-date. It average across across the 6 regions that the World Bank kind of defines according to the World Bank definitions. And we see that the most severe inflation is taking place in South Asia, the South Asia region, which is the same as in terms of the severity as the World Food Price Index. And then we have the other regions, Latin America and the Caribbean, the Central Europe and East Asia, the Eastern Europe and Central Asia, Sub-Saharan Africa, and the Middle East and North Africa, all those regions averaging around 15%. That's the year-to-date food price inflation in those regions. And as I mentioned earlier, the region to the right, which is the East Asia and the Pacific region, has experienced a much lesser inflationary impact from food price inflation. And that, at least in my opinion, reflects the fact that rice prices have been much more stable compared to other commodities. And of course, this region depends quite a bit on rice. That's why we see that outcome. Now, when we look at countries within regions, then we have, of course, countries that have a huge price inflation. For example, some countries in Africa, like Zimbabwe, Lebanon, and Venezuela, run inflation. They have inflation at a 3-digit level. And we see countries such as Sri Lanka, Turkey, or Iran and Argentina, which have a number of domestic problems, financial and economic problems. We see that their inflation rate, fluctuates around 50%. Lastly, I just want to make a small mention on fertilizer. Fertilizer is a very important market because it's used, as I said earlier, by most food commodities, especially grain commodities. We did see a huge increase in fertilizer prices, probably double or triple, depending on the type of fertilizer you're looking at. We see that to the chart on the left. And what we see also to the chart of the right, there we have defined this index of fertilizer affordability, which is the index, which is an index ratio rather of an index of food commodities over fertilizer, of food commodity price over fertilizer prices. And we see that the fertilizer has been much less affordable than what it was during the 10-year period between 2010 and 2020. It's not as bad now as it was in the peak of 2008 and 2009, but it's still much less affordable than what has been in the past 10 years. And this is one of the main risks that we think food markets may affect food markets in the short term and in the medium term. Let me give you a sense of a summary of our forecasts. that we publish in the report. In the report, we publish forecasts for more than 45 commodities. Here, I'm just showing you the indices. We expect energy prices to increase almost 60% in 2022 and decline by an average of 11% for next year. When it comes to food commodity prices, we have an increase this year, and we expect them to moderate by about 6% next year. And then in the bottom row, in the below rows, you can see fertilizer prices, which is the group that is expected to experience the largest price increase across all commodity groups, 66% this year. Again, we expect fertilizer prices to moderate next year by 12%. It is very interesting to see how fertilizer prices here match the energy prices, because fertilizer prices is the group that's most affected by energy. Some fertilizers, in fact, are made straight out of energy. For example, the nitrogen-based fertilizers are made out of natural gas. With that, I will end my presentation. All the material that we have in the Commodity Markets Outlook, including data, are available free from our website. For the next 8 weeks or so, what we do is we are summarizing the main findings of the Commodity Markets Outlook in blogs. We have already published one blog, and we're pretty much publishing one blog every week, so please watch out. We have a number of other publications apart from the Commodity Markets Outlook. We have a book that we edited, Pete and I edited. In fact, we put the advanced edition, the one you see here, back online back in May, and we are going to have the final edition on the website very soon. And we have, of course, our major publication from our group, that is the Global Economic Prospects. The next edition is going to be published, I believe, the first week of January. With that, I would like to end the presentation. Perhaps, Pete, you may want to add a few things in the energy market that I missed, or you think it's okay for question and answers?
I can respond
to questions. Okay.
Okay, thank you very much, John, for giving us a snapshot of the main point of the Commodity Market Outlook, which was just released last week. For those of you who are joining the event, the PowerPoint that John just showed has been already posted on the announcement page of the seminar. So please take advantage of it by downloading it and then use it. Thank you. We have a pleasure today of having Mr. Tatsuji Koizumi, who is the Chief Researcher at the Policy Research Institute, Ministry of Agriculture, Forestry, and Fisheries of Japan. So we would like to ask Mr. Koizumi to come in to share your comment, please.
Thank you very much, Coach. Okay, excellent. John, thank you very much for your sophisticated snapshot for the recent outlook, commodity market outlook. So we have been waiting for 6 months for the new releasing. Yes, we are using your projection, forecasting, so price data, fixed data. Yeah. So I'm Tatsuji Koizumi, Chief Economist of Policy Research Institute of Ministry of Agriculture, Forestry, Fisheries, Japan. And I'm responsible for global agriculture and food demand and supply market projection and analysis. So therefore, my comment focus on the global agriculture commodity market outlook. Yeah. Thanks to your presentation, we understand that the linkage among the energy, agriculture, agriculture commodity, metal and mine, and other raw material are strong. The nexus is very crucial, we understand. And it means that the price volatility can transmit from energy market to fertilizer and agriculture and mine and coal and other commodities. And we understand that sharp global economic growth slowdown is waiting on commodity prices next to 2 years. And your price forecast has, of course, numerous risks and uncertainties. Yeah, we understand. And as for your presentation, so we impressed from your presentation slide as for 15. So we concern for the decreasing stock-to-use ratio for global food. And you stress that many countries are conducting trade restriction, especially for the export restriction for wheat and other staple food. Yes, and yes. And so, as for the slide 17 shows that fertilizer prices. So you mentioned that. So, of course, fertilizer prices. So urea, the ammonium phosphate, and muriate of potash are decreasing this April, decreasing trend. And your projection forecast will decrease to 2024. But we concerned that the price are higher than year ago, last year, and the previous years. We are still concerned for the higher fertilizer prices as input for the agricultural production. And based on your report and presentation, I have 3 comments. Sorry, for the comment and question for your presentation. So first issue is slide number 12, and you mentioned that so food prices are rice prices have been stable during the 2000 past 2 quarters, and so this is quite a different trend from the wheat and maize and oilseed and other grain market. Yes, it is. Yeah, and this is unique and different trend from other grain market because you mentioned that rice. So global rice supply is ample. Yes, and most of the countries, most of the country are conducting traditionally oriented towards self-sufficiency, and rather than self-reliance strategy. In most of countries, most of the countries is conducting self-reliance strategy for the wheat and other commodities. But the rice is quite different, especially for the Asian countries. And of course, indica rice, yes, rice price is stable. Yeah, yes, it applies to indica rice market. Yes, as you know, rice is not strictly homogeneous commodities. So indica rice price decreased by 7.2% from January 2021 to September 22. Yeah, and decreasing trend. But the Japonica rice is increased by 22% compared to last year, and especially for the California medium rice prices are increased due to the high drought in California, and so indica and the Japanese rice market have different market structure, and so price movement are quite different from each other. So yeah, and so based on our OECD study, so international and domestic rice market can be divided into to separate both markets. Yeah. So if possible, so could you please consider to cover not only indica rices, Thai and Vietnam prices, but also Japonica rice price data, for such as medium rice price in California or FAO, so Japonica rice index in the Pink Seed and Outlook. Yes, of course, we are very pleased to collaborate with your data set and Outlook. Yes. And our other issue is projection. So yes, so for the projection, last slide, you showed that to slide number 18. Yes. We are strongly interested in the future price forecast to the year 2024. Yes, and I'm now belong to Ministry of Agriculture, but I work at the OECD. I was responsible for the cereal and biofuel projection until May 2022. Yeah. And so based on those, according to our recent outlook, released this June, so the agricultural commodity market will remain high in 2022, but after 2024 has a decreasing trend due to because of the So increasing so productivity and the lower so growth rate for the demand sector, especially per capita, derived from the so GDP. So growth ratio will be much lower than last decade. Yes, and we agreed with your price forecasting. Yes, and yes. And so, but also second comment is a question and uncertainty for the price so forecast. So, yeah. So you based on the your report, there are plenty of uncertainty and risk for the future commodities price forecast of 2024. Yes, you mentioned that. So your report mentions that. So yes, global prospect macroeconomic uncertainties. The war in Ukraine, input cost, extreme weather event, La Nina, trade policy, and biofuel, and others. Yes, but what do you think about other factors such as disruption on transportation, and increasing of maritime transportation costs? Yes, and rural agricultural investment, especially for the Ukraine and the other countries. Yes. And plant animal diseases and desert locust infestation, and yes, other risk and uncertainty for the prices price forecast. Yes, and yes, third issue is my comment is food insecurity. As for the slide 16, it's very impressive. So slide it reports that local food price has surged in response to increase in the energy and fertilizer prices since 2021. Yeah. And many countries are suffering. It shows that many countries are suffering from the commodity-driven inflationary pressure with depreciating currency. It's a double impact from yes, and I think so. We think a crucial issue is household damage depend on the Engel coefficient in the economy and the household. Yeah, because of the rising food commodity price tend to affect lower income household and relatively more than higher income consumers. Yes, and lower income consumers spend a large share of their income on food, and the low income household and country tend to account for large share of food expenditure for staple food, wheat and wheat. Yes, not only Engel coefficient, but the lower countries has a high share of the spending for the staple food. Yes, and consumer in some lower income food deficit countries are very vulnerable because they must rely on imported supply subject to higher world prices. Yes, of course, with the depreciating currency. Okay. Yeah. Okay. This is my comment and question. Yeah, and also Dr. Buffett. So thank you very much for your presentation in Tokyo. I counted your presentation. November 2014, December 2015, September 2017, and this time 4 times. And yes, and so furthermore, you presented, you have conducted so many outreach CMO events in online. Yeah, and we are running through the nexus linkage of the energy, agriculture, mine, and other raw materials. Yes, and your presentation, the message are very opening eye for us, and so we awareness rising from the commodity linkage and the nexus. Yeah, yes. Thank you very much again. Thanks. Yeah. Okay.
Thanks.
Yeah, thank you, Koizumi-san. Yes, you may want to directly respond to Tatsu's comment actually quickly. Then we open up a floor. Yeah, please. Before forgetting actually the point, please.
Exactly. Yeah, thanks a lot for your comments. Very much. Sorry. Thanks, Pete. Thank you, Tatsu, for your kind words about our report. And you raised very interesting points. I'll start from the last one, the food insecurity. This is a very short, I mean, this is a very summary picture of what we show here. But the issue with food security is that the people that are subject to food security has unfortunately increased quite a bit. For example, I'm looking at the numbers which we published in the report. People that are in severe food security, the so-called IPC 3 and 4 phase, as it's defined by FAO, it increased from a bit over 100 million back in 2016, and the estimate for this year, which takes into account the war in Ukraine, may be above 200 million. So we have a doubling of the people that are subjected to severe food insecurity, and that's, of course, it's not fully captured in the charts that I show you. I fully agree with you on this. Now, on the projections, you raised a few good points that because of the various disruptions and transportation, and perhaps not having the required investment for the agricultural production, and especially now with a higher interest and environment, investment is going to be much more difficult. We do see your point that the gains that we may have in productivity, which are long-run gains that take place across most commodities, especially agricultural commodities, may not be enough to counterbalance the issues that you raised for at least in the foreseeable future. So certainly those are two concerns, or rather risks, that are very important. Now, on your very first point of japonica rice, I will take your consideration seriously in the sense that we will see whether we can include that in our price data sheet. We do include 3 or 4 rice prices, but unfortunately we have not incorporated, we do not monitor, or we do not report rather japonica price, but you raised a very good point. And again, as it's the case with most commodities, it's also the case with rice, you have different markets. I mean, the most important example is the natural gas markets, with hugely different behavior there, and this is the case to some extent in rice. So we'll take that into consideration. Again, thanks for your kind words and your comments.
Thank you very much, John, for your responses. Now I'd like to open up the floor for the first time since February 2020 to collect the questions in person from our participants in the rooms. If you have a question, please raise your hand, put the microphone on, and raise your questions. ご質問がありますか？もしよろしければ。Yes, please, Tom.
Oh, it's switched on now. Thank you. Sorry, John, Thomas Sullivan's my name. Thank you for coming to Tokyo to speak to us today. You mentioned Brazil specifically in terms of coffee prices. I just wanted to ask, you know, if the World Bank has a view. Obviously, they've just had an election there. You know, Lula, it looks like, has been elected president of Brazil. But do you see any potential disruption to energy or food prices because of, you know, it's going to take 2 months for Lula to be installed as president of Brazil. So I'd just be a little bit concerned about the situation there. And I was just wondering if you could expand a little bit on the fertilizer prices. Is that caused mainly by the Russian-Ukraine conflict again? And just finally, on the oil price, you mentioned the figure of $80 in 2024. I'm just wondering how the Saudis would view that, because obviously they've just cut production by 2 million barrels a day, as you mentioned, and they seem to have a price target of $100 for Brent or Dubai or whatever index it is they use. Yeah, my three
Okay.
Thanks.
Okay, thanks for the questions. Do you want to say something about energy? Then I'll get back to agriculture. Yeah. But before you continue, let me say, we try to stay away from politics.
I see.
Yeah.
Okay.
So we'll answer some of your questions, but not all of them.
Right.
Thank you. So my name's Peter Nagel. I'm a senior economist at the World Bank, where I focus on energy markets. You raise a very good point. It certainly looks like the objectives of OPEC and OPEC Plus group have shifted a bit. So originally they were supporting prices, and then COVID happened, and they had a huge response to that, a huge reaction, cut production, probably much more than people expected, really. Mm-hmm. But now going forwards, it does look like they do seem happier with a higher price than we had expected, say, in 2018, 2019. And I think to some extent that reflects what we see in the US. So if you think back to 2018, 2019, the reason why they didn't want prices above, say, $70 a barrel is because of US shale. And every time prices went up, US shale production started ramping up and OPEC lost market share. Now, today, what we've seen in the US is that, as John mentioned, the way in which companies are responding to higher prices is very different. They're focusing much more on returning cash to shareholders through dividends and share buybacks, rather than just increasing production at all costs. And so I think from the OPEC perspective, they feel like they can not get away with, but a higher price isn't likely to lead to that equivalent boom in US production that it has done. Now, our price forecast, returning to $80 a barrel, we anticipate some further increases in US production. In fact, that's the main source of new production. But I will caveat that we do think that the balance of risks is to the upside. Now, of course, demand is also a big factor, and the slowdown that we've seen, and I think particularly worries about a global recession next year, have been weighing on prices. And so that's another factor. But one of the things we highlight in this report is simply that there are so many risks at the moment that forecasting is always an uncertain business, but I think it's particularly uncertain at the moment.
Yeah, on the fertilizer in Brazil, yeah, they had weather issues last year. It affected both the year before, in fact, the season before. It affected in a big way coffee production. That's why we saw a doubling in coffee price, or more than that, I would say. And even this year, the situation, the coffee production is much better than it was last year, but it's unlikely that Brazil will refill all the gaps, the shortfall, last year's shortfall. That's why we do see even now coffee prices staying high, being high levels. And also they had the issues in South America in general, issues with soybean production. That's why we saw soybean prices being pretty much as high in terms of percentage increase as wheat prices. Now, and I have to mention here the La Nina, which I didn't elaborate in the presentation, is that La Nina also affected to some extent South America production. Now, La Nina is not as severe as the El Nino. El Nino is a more severe phenomenon than La Nina. But when it comes to South America and South Africa, La Nina does play a role. But the more worrying part of La Nina is not that it affected commodity production, of course, last year and the year before, and perhaps this year in South America, is the fact that La Nina this year is taking place for the third year in a row. And according to many analysts and economists, that's a worrying sign that it may be associated, with specification of weather patterns, etc. That's, I would say, the more worrying part about La Nina, in addition, of course, to the negative impacts it has on production. Now, on your other question on fertilizer prices, yes, fertilizer prices increased long before the war in Ukraine. And the main reason is because energy prices went up. And in fact, it was last year, I believe, in the summer, not I believe, it was last year in the summer, when we saw a number of chemical companies in Europe to shutting down the fertilizer production facilities because either the natural gas prices were very high, or in some occasions they did not even have access to natural gas prices, or whenever they did, even when they did, they had to ration it and direct it to chemical products that were outside the fertilizer production. So, yeah, the short answer to your question is that fertilizer prices have been up, have been increasing long before the Ukraine war, and the Ukraine war made it much worse because both Russia and Belarus, of course, are key fertilizer producers, and yeah, you have the issues from the region, and then we also had some issues in fertilizer production, rather in trade. China imposed an export trade on some types of fertilizers because, of course, they wanted to keep it for domestic production. And some other countries also imposed a few restrictions on fertilizer trade. So we had before the Ukraine war, and some trade restrictions around the world that affected the fertilizer prices. But of course, the war in Ukraine was the icing on the cake, so to speak, that affected the market.
Thank you very much. We had a pleasure of having John Buffett, who is a senior agriculture economist at the Prospect Group, and also we had Pete Nagel joining the discussion from the same group, and also we had a honor to have Mr. Tatsuji Koizumi from the Ministry of Agriculture, Forestry, Fisheries as a commentator today. Thank you very much for everyone to join the seminar. We are going to organize several more seminars this week. In fact, Friday morning, 8 a.m., we are going to have another seminar on Europe and Central Asia economic update. This is going to be YouTube only, again, Friday, 8 a.m. And then on the same day, in the afternoon, on Friday, 1 p.m., we are going to have John and Pete again as a speaker, and then they are going to present the new book, Commodity Market. This is going to be actually in person, face-to-face, and the virtual participation in a hybrid manner. So please check our website for the detailed information. In fact, more the seminars are coming up in the next few weeks, but please stay tuned and keep your eyes on the website. Thank you very much once again. Thank you.